What if I told you that gold just posted its worst week in nearly a month, dropping below $2,370 per ounce, while Wall Street's biggest names are now completely split on where it heads next? The precious metal that investors have relied on as their ultimate safe haven is suddenly facing its biggest test in months. This dramatic decline marks gold's first weekly drop in 3 weeks, with prices falling nearly 2% as Middle East tensions showed signs of cooling. The metal hit its lowest point since June 12th, sending shockwaves across financial markets. But here's what makes this story truly fascinating. Major investment banks are now painting completely opposite pictures of gold's future, and their predictions couldn't be more different. The immediate catalyst for gold's retreat centers on shifting geopolitical dynamics. Recent developments suggesting a temporary pause in Middle East escalations have reduced fears of a broader regional conflict. This has diminished gold's appeal as a crisis hedge, with investors rotating out of safe haven assets. However, the situation remains incredibly volatile. Underlying tensions haven't disappeared, and any renewed conflict could quickly reverse this trend. Adding fuel to the sell-off, the Federal Reserve's latest stance has dramatically shifted market expectations. Chairman Jerome Powell's recent comments about persistent inflation risks have reduced hopes for aggressive interest rate cuts. Since gold doesn't pay interest, higher rates make it less attractive compared to yield-bearing investments like bonds and savings accounts. This creates a double hit: reduced geopolitical demand combined with less favorable monetary conditions. But here's where the story gets truly compelling. Wall Street's top analysts are taking completely opposite sides of this trade. Citigroup has turned dramatically bearish, forecasting a shocking 60% probability that gold crashes below $2,000 per ounce by 2026. They're predicting prices could plummet into the $1,500 to $1,700 range, citing eased policy risks and weakening demand from key Asian markets. In stark contrast, Goldman Sachs remains aggressively bullish, maintaining their bold $3,000 per ounce target for 2026. They expect gold to rebound to $2,700 by year-end, supported by ongoing global uncertainty and structural demand shifts. JPMorgan echoes this optimism, predicting prices near $3,000 by mid-2026, arguing that current weakness represents a buying opportunity. This division reflects gold's complex relationship with multiple risk factors. While recent developments have temporarily cooled some concerns, the underlying drivers that pushed gold to record highs earlier this year remain largely intact. Central bank buying continues, inflation concerns persist, and geopolitical risks can resurface without warning. The current pullback may represent either a healthy correction before the next leg higher, or the beginning of a more significant decline. With major institutions taking opposite sides, gold's next major move will likely depend on how quickly global risks resurface and whether central banks maintain their hawkish stance. Subscribe for more market analysis as this gold story continues to unfold.